subject. So we are talking about the valuation. Okay. So when we talk about valuation, then we say how do we value a company? How do we value a share? How do we value a building, okay, or a property, or any asset, except very few like gold, which is not an economic asset. So any asset which produces some kinds of return or cash flows or kind of a return to the investor, because we keep investing money in our life. At the moment, your parents are putting a lot of money in various forms of investments. They are just securing their future. When they retire, they should have enough money to take care of themselves as well as their children, so they can set up their them up, and the child education, the marriage of son and daughter. So the parents, they make a lot of investment. So this is a course which help you that also. Apart from valuing a company, whenever a company wants to buy another company, in case of a merger and acquisitions, the company why a company would like to buy? Because they want to grow their business. Okay, they want to grow their footprint, because they want to become bigger in much lesser time compared to an organic growth where you set up a new plant by buying a piece of land and setting up a factory, buying new machineries, equipment. It's called organic growth. In an inorganic growth, you do it much faster by merging with other companies or acquiring other companies. So when you are trying to buy another company, so you would like to know, what price I should pay for that company as an investor. Okay, so this course helps you that. Then, if you are coming with an IPO, that means you are raising your money by raising through issue of new shares, either an IPO or an FPO. The first time when a company raises money through a stock exchange, it's called an IPO. They become public after that. Their stock get listed, and subsequently when they raise money, it's called FPO. Okay. So, when the company is raising money, either in an IPO or an FPO, if the company has already done business and it has some past history, okay, even if it's a startup company, it has spent a lot of time in developing the products, taking the product out in the market and trying to sell and create some market. So the company has attained some value. Okay, so they would like to know what is the value of the company. They can't offer shares at par to the new investors, so they like to charge some premium when they come from an IPO. Okay, so that means you have to value a company. So this course is again handy to understand how do we value a company, for finding out what kind of premium we are going to charge on an IPO or listing of new shares. So name anything, even if you are working somewhere, or you own property and you want to distribute among your joint owners, or you in a family, when the property is distributed among from one generation to another, so you like to value those assets. So this course helps you do that. So this is a course which takes care of every aspect of your life. Okay, if you want to invest some money somewhere, where do I invest? How it will grow, where I'll get the highest return. So this course is for that also, for everything. It's a one course which covers everything. Okay, fine. Now, so when we talk about valuation, there are lots of methods through which we value a company. Okay, and one of the valuation method is called the discounted cash flow technique, which is intrinsic valuation. Okay, which is the most appropriate method, which calculates the real or the fair value or the right worth of an asset or a share. Okay, it's a longish method and involves a lot of assumptions and lot of resources, and so since there are a lot of assumptions, so people can come up with different values of the same asset. Okay, because the assumptions can change. Okay, from person to person, from an analyst to the company. In a company, if there is a CFO, CEO, or the managing director of the company, if you ask some assumptions, everyone will come with different assumptions. So you will value a company differently based on what are the assumptions which have been taken to value a company. So assumptions can change the valuation. Okay, so that is called the DCF method, through which we calculate the intrinsic valuation. So we'll come to that later. Of course, I'm recording it. You can just hear it so many times, and I'll share some more videos also, which you can watch. So the second method, the most popular method, which is used very widely in the world, most easiest method is called the relative valuation. Okay. So what we started was, we generally normally a guy would start from DCF valuation method, but I started with relative valuation because it is much easier and it creates a lot of interest among the students, because they easily understand that, and then doing intrinsic valuation becomes a very easy job and they can understand what they are doing. Okay, since it involves a lot of calculations, so there will be two projects which I will be giving. Okay, one will be on the basis of relative valuation, another will be on the intrinsic valuation. And I expect, because there are about I think 27 students or 25 students, so maximum, maybe that is my wish, you can always change that. So 2 students per group or maximum 3 students per group. Okay, but most ideal will be 2, because lesser, normally I would like it should be an individual kind of a thing, because you will learn yourself. Okay, so if anybody wants to do it solo, I am okay with it, but if 2 people can join and do it, wonderful. If you think that there is a lot of work, then you can have another person. Okay, so that many minds can always change the things, but all have to equally contribute. If there are more than 2 people, 3 people, then I'll watch what was the hard work done by you people, then you will be assessed on that. Okay, don't think that 2 people work, one person just watches and he will also score. It's not like this. The good presentation marks will be divided on whatever hard work you are doing, and I'll come to know that. Okay, so we are talking about first the relative valuation. Okay, so I have shared a blank template on WhatsApp. Okay, so that is what you will be doing, but today I'll be just doing one case myself, and you will be just completing that, and then you make a choice of your own company as a group. Okay, so not at the moment, maybe from next Tuesday onwards. Abhi 2 classes mein we'll understand everything, and by the time you just decide among yourself who will be your partner, whether it will be doing solo or will be doing 2 students or 3 students. Okay, fine. So that you have to choose. So what we are doing is we are trying to understand the relative valuation. Now I am not going to repeat what we have done, so watch the video. Okay, you haven't missed anything. If you watch the video, you will be at par. So today when you go home, any students who have joined recently, so they can go and watch those videos. Fine. So relative valuation. So this is the first mechanism which we'll be understanding. Okay, so we are just doing the same thing. Okay, but I'm just skipping the intro parts which we have done already. So now we are doing, so what we have chosen a company. Okay, now there is a site called Screena. Okay, and the company which has chosen is Ultratech Cement Limited. Okay, fine. And there are many cement companies in India. There are about in this there are 7 companies which are given, but there are about I think 14 to 15 cement companies which are listed in India, and these 7 companies which are given here, they contribute almost 50% of the market share, which is a good size. Okay, if you are covering 7 companies and analyzing them, then you are covering almost 50% of the market. Okay, but then about 30 to 40% of the market share is held by unorganized sector. I mean, some small cement companies which are not even known, they are producing cement, they are not listed and their data is not available. So almost like 70% are listed companies, out of them we have picked up 50%. Okay, so first company which we are talking about is Ultratech. It's a Aditya Birla Group company. Okay, so Ultratech company is engaged in manufacturing and sale of cement and cement related products, primarily across the globe. So it's a global player. Okay, and this is the largest company, cement company in India, which the market share is close to about 23% in India. Almost like 23% and 24% of cement is manufactured by Ultratech. Okay, I'll give you the market share of all the companies. I've just made a template. So the same template you have to make yourself for any company which you are going to choose. But this is for Ultratech. This is for cement industry. Okay, so if you look at briefly what we touched was that there is now if you are familiar with this site, so you have to make a ID and password, okay, of this site. Then you have to add all these ratios. There are certain standard template which are available, but then there will be only 8 or 9 ratios or metrics, so you have to make little wider. Okay, it will allow almost like 15 to 20 or 30 kind of things which you can add on. So here how do we do is basically we just go to this add ratio table and put that ratio which is appearing in my screen when you are watching a video, or I'll just pause, I'll give you a screenshot. Somebody can just take a photo of this and then put it on WhatsApp group so that you can add these. Okay, so take a snap of it and put it on a WhatsApp. Okay, so all these should be available on your screen. I don't think you require anything more than that. If you require, because then it will not allow, it's a limit. So I have put all the things which are allowed, but then you have to either delete one of the ratio and add another one. Okay, because that's the maximum capacity on the screen. Okay, so the first is the market cap, which means the total value of the company. The market cap, 3,60,000. So this is the biggest company in India in terms of market cap in a cement industry, and it is a large cap. It's a large cap. So I've shared, three types of companies: large cap, mid cap, and small cap. I've shared a list as per the latest, the SEBI regulations. So the top 100 companies are called large cap, and then mid. Okay, so this is a large cap. Who owns this company? Birlas, Aditya Birla, 3,60,000 crores. Okay, so this is basically the total value per share multiplied by the total number of shares. So you can arrive at this figure by taking the current price multiplied by number of shares. 29.5 multiplied by 12,250, you will get the market cap. Is that okay? Fine. This is your understanding. Then we have the current price. So this is the current price at which the share is trading. Okay, fine. And then we have the highs and lows. That means the 52-week high and low. So that means it was 10,048, the lowest somewhere in the year, and the highest it has touched 12,714. So currently it is below its peak. Is that okay? Fine. So if you want to know the prices little bit more, so you go to the chart. So you go to the chart here. So this is a 1 year chart, price chart and volume chart. So I am just. So if you see this chart, this is how the share price has moved. Okay. So it has been up and down, up and down. And in the recently, the share price has started moving up. Okay. So it's touched in the last 1 year, I think it might touch the highest. Fine. But or maybe 52-week, it's saying that somewhere it was higher also somewhere. Okay. So this is, or this was the highest to 12,000 something. Okay. And now it's been just gone a little bit down after the Trump announced, a 25%. There is some kind of uncertainty prevailing in the market, so which has pulled down the market a little bit. So this is how the share price has moved. The share price are not going to move linearly like up, up, up. It's going to be either up and down, up and down. But if you look at a longer duration chart, which is a kind of a whole history, so Ultratech has been going up, isn't it? So if you see, the share price has been moving up. So the long-term trend is bullish. If you have invested money, you have made a lot of money over the long term. When you buy shares, then you should remain invested in good company. Okay, you will get rewarded, but you will get rewarded over the time, over a maximum of 10 years. If you look at 10 years kind of a horizon, you are going to get about 10 to 15% kind of a return in the shares. Okay, depending on what shares you are holding. If you are holding large cap, a 10 to 12% kind of a return. If you are holding a mid cap, then around 12 to 15%. And if you are holding a small cap, it will be 15 to 16 to 17% of a return, because small cap gives you maximum return. Though they are more riskier, there is a lot of volatility. Okay, chances are they will give you higher return, because small companies, when they grow bigger. Okay, the bigger companies grow, but they grow at a slower pace. They can't grow big. After growing big, they can't keep growing like and becoming bigger and bigger and bigger. Very few companies will, somewhere it will have a normal growth kind of a thing, and then the share prices tend to follow a kind of a 10 to 12% kind of a return for large caps. So, when we look at a share and its return, we always look at, please listen, this is very important, it's a mean return. Okay? The mean return, which is called the expected return also at times. So, for every share, you must know what is its mean return. Okay? Now, this share may have a mean return, we will just understand that. The mean return would be around 12 to 13% on an average. It goes down also, it goes up. Sometime in 1 year, it may give you a negative return. In the next year, it may give you 30% return. But over the time, average is around 12 to 13% return. So, that's called the mean return. Okay? Most companies, they give you a mean return if you hold them over about 5 to 7 years or maybe 10 years. Okay? Fine. When you buy them, don't expect that, in that year it will give you a mean return. Over the time, it will give you a mean return. Okay? And mean return is called the expected return also. What it is called? Expected. So, for every share, there is an expected return, which is calculated by taking the historical price divided by the number of years. Fine. How much return it has given each year, add them up and take a mean of that. Okay? Fine. So, that is one mechanism. Now, the expected return is calculated on historical past. Okay? It is calculated on what? Historical past, not on future. If somebody can calculate return on future, then that will be a great thing. But since future nobody can predict, but we can always make some kind of a forecast. Okay? But the past returns gives you a kind of a fair idea, how much return it has given. No guarantee that it will give you the same return. Okay? But it's an average return. It has seen up and down, it has given still you an average return. So, most likely you are going to have that return. Unless the company has become very bad or become very good. It will give you much better than the mean return, but it has become worse, it may even not give you that much. The management has changed or something has happened drastic to the company. Unless that has not happened, then the average return, you may get it. Okay? Fine. So, this is this thing. Now, we come back to a 1 year return. Now, in a 1 year return, it is telling you that the stock has moved, in 1 year, the Sensex, Nifty, they haven't moved much. In August last year, we touched the peak of the market. Okay? Nifty touched about 27,000 thereabout. And now it is languishing at around close to sub 25,000. Okay? So, it has not given a positive return. The broader market has not given a positive return in last 1 year. Okay. It's not bad because prior to that, the market was galloping. Okay. So, over the 5 years, the market has still given you around 15 to 18% return. Maybe this year has not been so good, but it's okay. There has to be some pause somewhere. You can't expect the market to do well all the time. When I am teaching some students, they ask me, sir, कौन से market में stock लगाएं? तो कौन सी कंपनी में लगाएं पैसा? So, I was teaching some armed forces people, some like group captain, Navy, commodores, everything, journals, everything. So, they were about close to retire. So, they were looking, where to put money. So, it was last year, somewhere about June, July. So, the market had already given good returns and they were all seeking, where to put money. And when they asked, I have to tell them. But I tell them there is no guarantee whether the next year will give you the same return. But if you hold the stock for long, you will get a good return. So, couple of guys, they invested last year. So, by the time they invested, it was August. So, they invested at the peak. I was telling them right from January, February, ab laga do paisa. But, people take time to decide, where to put, when to put. So, they put the money in the month of August or July. Stock went a little up, so they were happy. But then the market came down and, they were not very happy about the way the market was going and they were not making good returns. They were making losses. The market started coming down. One of the guys was kept talking to me every day. From last 3 months, he has not even talked to me. He has lost interest in the market because his returns, and he has not grown so much. Okay. But anyway, so one has to, I told him, be patient. You will get 15% return, 12 to 15% return over the next 5 years. So just watch my words. But it's not like you should stop investing. If you have invested at a peak, so you should keep investing so that you have you have invested over all the times, so you get a good return. Otherwise, you keep investing at the peak, okay, and you will never make a return. Anyway, so now there are two very good indicators. There are two very good indicators, long-term indicators, and those are called, the 50-day, the 200-day moving average. Okay, so this line which I have drawn is 200-day moving average. Fine. If your share prices are above this 200-day moving average, then the long-term trend is good and intact. This stock is going to go up. This is a 200-day moving average. That means every day 200-day prices divided by 200, so you get an average. So this 200-day average filters out the noise in the daily pricing. ये तो हर दिन का प्राइस है और ये जो है 200 दिन का है. So this is going to take a lot of time to change the direction. Okay, the particular day price तो रोज का प्राइस है, कभी भी जा सकता है कहीं, but ये काफी टाइम लगेगा change the direction. So this is a smoother line. Okay, and it is called a lag indicator. It's called a lag indicator. That means it's not going to predict you anything, but it can tell you which way the market is heading. Okay, fine, unless the trend changes. Okay, so this is currently the market is in bullish phase. That means the share is bullish. You should invest. Okay, now this is not the end. There is one more moving average which is called a 50-day moving average. So if I just put this, so this is a short-term moving average, which is much faster than 200-day moving average. Okay, so there are pair of moving averages. Now there are three things: the price, the 50-day moving average, and 200-day moving average. What I am telling you is called technical analysis. Okay, through technical analysis, like we have, the horoscope people, they are astrologers. So this is like a same science, okay, where you can know what is the future of this thing. So this is a little bit a longish term kind of a chart. So the 50-day moving average, the price should be above the 50-day moving average. If the price is above the 50-day moving average, that means even the short term looks good. But here the long term and short term looks good because the price is hovering above the short term and the long term moving average. Is that okay? Now, apart from that, there are other averages also: 30-day moving average, 20-day moving average, 10-day moving average, 1-day moving average, hourly moving average. So these are basically the lesser it becomes for a day how the market is going to do. So there are intraday traders also. रोज सुबह पैसा लगाते हैं, शाम को निकल जाते हैं, तो उनके लिए फिर वो मूविंग एवरेज छोटी होती जाती है. Okay, now so these blue lines are called the volumes. How many people are buying shares on that particular day? Okay, number one. So the volumes, the moving averages become the cornerstone for understanding the technical analysis. If the share price is going up with a higher volume, then the trend is pakka. Okay, the trend is going to follow. If the share price is moving but the people are not buying, volume is not growing so much and still it is going, so that means there is a divergence. Less people are buying, share price is moving up, so that means the share price is going to fall any day. It's not going to sustain. Okay, so that's another kind of a analysis. Then, if you look at, there was a, here, now these lines, moving averages, they act as support and resistance also. When the share price falls below these moving averages, first of all, it is very difficult to break the moving average. It can break, but sometimes we find the line will become a kind of a support for the share. If the share tries to fall below the moving average, next day share price will go up. Okay, because it has fallen, it has touched the support where the share price will find a support in the market and share price will bounce. Unless the support is broken convincingly, then we say the trend has changed. Okay, so the moving averages act like support. Once it has broken the support, it's very difficult to pierce the support. that support and it will become a resistance. एक बार support break हो गया, उसके बाद share price ऊपर जाना मुश्किल हो जाता है. Each time the share price is going to go up, it will the moving average will become like a resistance. Okay, fine. So we will understand that later, but you can always read through those things. So here, whenever the two lines crisscross each other, so either it is called the golden cross or a dead cross. When the short-term moving average crosses the long-term moving average decisively, it's called the golden cross. That means good time has begun. But if the 50-day moving averages pierce through the 200-day moving average below, then it's a dead cross. That means the share price is now turning bearish. There are two important signals. So here, the 50-day moving are always up. It has not happened, no cross has happened, but here it touched and then went ahead. Okay, so almost like a small signal of a golden cross here, where the share price started going up thereafter. And here, the share price has tried to pierce the 200-day moving average, the major support, and then the share price went up. ये मेरे हाथ लगाने से हुआ. If you look at there, the share price has tried to break the 200-day moving average, okay, but then, so if the share price tries to break the 200-day moving average, then it will act as a resistance. Okay, the share price is going to okay. Is that clear? Now, rest of the things you can understand, and when you do your project, so there I have given a line for what you can do, when you read this chart. The simplest thing is you take a snapshot of this chart, go to AI and say analyze for me. It will tell you the same thing which I have told, and it will tell you, what the chart looks like, how you can view a share. Is it likely to go up or go down? Pick up the punch word and put in your project. Okay, this is what the charts of the company tell. That's all. Okay.
So in March 2025,
Huh?
in March 2025, the share prices went down,
Yeah.
but the volume of people buying that share went up.
Yeah.
So what does this
Now, at times, that's very important question. The volumes can go up and down. Now, if the volumes go up and share price go up, good thing. If the volumes go up and share price goes down, that means something bad for the company. People are selling more. People think that the company is not going to do well. They are selling and the share price. So volumes will go up and share price will also fall. So that's the worst thing to happen for a company, where the volumes don't go up, volumes go down, and volumes go up and share price goes down. So that means there is a lot of people are selling, because there was some bad news in the market. Okay, so anyway, so that is what it tells. अभी तो इतना ही काफ़ी है इसमें अंदर के लोग. It's a huge science, okay, and huge time it takes to understand everything. And now there's last word before we leave this technical analysis. Now this technical analysis only works when the markets are trending. अगर मार्केट ट्रेंड हो रही है तो ही ये मूविंग एवरेजेस आपको सही सिग्नल देंगे. इफ द मार्केट्स आर नॉट गोइंग एनीवेयर, दे आर विद इन अ बैंड दैट्स कॉल्ड रेंज बाउंड, then these signals don't even give you a proper this thing kind of this. So don't draw any conclusion about 50-day, 200-day moving average when the share price is hovering between 80 to 100 for last 1 year. Then these moving averages is not going to tell you anything. Then they will fail. Then you have to move to another technical indicators rather than to moving averages. So and we are not going into that. Okay. So then you have to go to oscillators and stochastics. So we are not touching that. Okay. So we go back to okay, we come back to this chart. Is that okay? Now, stock PE. Now, the PE is very important.